You know what's wild? Most people I talk to are stressed about inflation, worried about their retirement accounts, watching their portfolios bleed red every time there's a news alert about some conflict halfway around the world, and yet those same people are completely ignoring the one sector that has literally been printing money because of that chaos. Not in spite of it, because of it. And I'm not talking about some shady, obscure corner of the market. I'm talking about one of the oldest, most government-backed, most recession-resistant industries in human history. And chances are you have zero exposure to it. My name is Smith, and I spend way too much time thinking about how geopolitical tension turns into portfolio returns. If you're someone who watches the news, feels the anxiety spike every time a new conflict breaks out, and then just closes the app and hopes your index fund handles it, hit subscribe and give this video a thumbs up. Because today we are talking about defense stocks, and more specifically, the three that I think are best positioned to benefit from the world that we are actually living in right now, not the peaceful, globalized world we thought we'd have by 2025. Now, before you tune out and say, I don't want to invest in weapons, I hear you. I genuinely do. And we're going to talk about that. But here's the thing. Whether you personally own these stocks or not, someone is buying them. Pension funds are buying them. Sovereign wealth funds are buying them. Institutional investors are loading up. The question isn't whether defense makes money. It clearly does. The question is whether you want a seat at that table. Stick with me because by the end of this video, you're going to see this sector completely differently. Let's start with the world as it actually is right now. Global military spending hit a record $2.4 trillion in 2023, according to the Stockholm International Peace Research Institute. That's the highest figure ever recorded in human history. And it didn't slow down in 2024, it accelerated. NATO countries are scrambling to hit their 2% of GDP defense spending targets. Many of them are going well above it. Germany, which barely spent on its military for decades, announced a complete reversal of its defense posture. Poland is spending nearly 4% of its GDP on defense. The United States budget for fiscal year 2024 included over $886 billion in defense spending. Let that sink in. $886 billion in a single year from a single country. Here's what most people don't realize. That money doesn't evaporate into thin air. It flows somewhere. It flows into contracts, multi-year, government-backed, essentially guaranteed contracts with a very short list of companies who have the infrastructure, the security clearances, the intellectual property, and the supply chains to actually deliver. We're not talking about a startup trying to break into this market. We're talking about an oligopoly with incredibly high barriers to entry, where the customers are governments and the payments are legally mandated by national budgets. Now you might be thinking, okay, Nick, but defense stocks already ran up. I missed it. And look, I understand that instinct. It's the same instinct that made people say, I missed Amazon in 2015, or I missed Nvidia before the AI boom. The question is never whether you missed the first wave. The question is whether the structural demand that created that first wave is still intact or growing. And right now, it is absolutely still growing. This is where it gets interesting. Let's talk about what I'm calling the defense portfolio. Three companies that I believe represent not just a trade on current events, but a long-term structural position in a world that, unfortunately, is not becoming more peaceful. The first company is Lockheed Martin. If you don't know Lockheed, here's the simplest way I can put it. When the U.S. government needs something that flies, explodes, or defends the country from things that fly and explode, Lockheed is almost always involved. They are the largest defense contractor in the world by revenue. In 2023, they generated approximately $66.6 billion in net sales. About 74% of that came from the U.S. government and the rest from allied foreign governments. So their customer is quite literally some of the most credit-worthy entities on the planet. Their crown jewel is the F-35 Lightning II, the most advanced fighter jet ever built. There are over 3,000 F-35s on order across 17 countries. Each one costs somewhere between $80 million and $100 million, depending on the variant. The program is expected to generate over $1 trillion in revenue across its entire life cycle, and Lockheed is the prime contractor. That's not a product, that's a generational annuity. But here's the psychological piece I want you to sit with for a second. Most retail investors look at a stock like Lockheed and think the price already reflects all of this, and that's partially true. Institutional investors are smart. They price in a lot. But what they consistently underestimate, and this is backed by decades of behavioral finance research, is duration, the length of time a structural trend can persist. Humans are bad at modeling slow-moving, long-duration shifts. We think in quarters. These defense contracts run for decades. The F-35 program lifecycle runs into the 2070s. The revenue tail on a contract like that is almost incomprehensible in normal stock-picking terms. Now, Lockheed also pays a dividend. As of late 2024, the yield was hovering around 2.8 to 3%, and they've been a consistent dividend grower, part of the exclusive club of companies that raises its dividend year after year. So, while you're waiting for the long-term thesis to play out, you're getting paid. That's not nothing. In fact, if you had invested $10,000 in Lockheed Martin 10 years ago and reinvested every dividend, you'd be sitting on roughly $38,000 to $42,000 today. That's a 4x return, quietly, in a company that most people think of as boring.
Let's move to the second name, RTX Corporation. You might know them by their old name, Raytheon Technologies. This is a different kind of defense play, and I love it for a specific reason: diversification within the sector itself. RTX has two major defense-facing segments: Raytheon, which makes missiles, radar systems, and cybersecurity products, and the broader Pratt & Whitney engine division, which powers everything from commercial aircraft to military jets. The Raytheon segment alone generated over $24 billion in revenue in 2023. And here's the stat that should make your jaw drop. After the conflict in Ukraine began in early 2022, demand for Raytheon's Stinger and Javelin missiles absolutely exploded. The U.S. government sent tens of thousands of these systems to Ukraine and then turned around and handed Raytheon billion-dollar contracts to replenish the stockpiles. That's the business model in one sentence: spend it, replenish it, repeat. But here's the thing that makes RTX genuinely interesting beyond the current cycle. Their radar and air defense systems, specifically the Patriot missile defense system, are now in demand from virtually every NATO country that borders a potential conflict zone. Poland just signed an $800 million deal. Japan is expanding its Patriot battery network. Saudi Arabia, UAE, South Korea. The customer list reads like a geopolitical anxiety map. And every single one of those governments needs not just the hardware, but the maintenance contracts, the upgrades, the training, the software. RTX has a services and support business that creates recurring revenue long after the initial sale. Here's the metaphor that I always use for this. Buying a defense platform from Raytheon is like buying a printer from HP. The printer seems like the product, but the ink, the maintenance, the upgrades, the ammunition, that's where the real money is. And Raytheon has engineered their entire business model around that dynamic. Now, you might be thinking, okay, but what about the ethical question? I've been sitting with it this whole time. Look, I'm not going to tell you how to feel about defense spending. That's a deeply personal decision, and I respect that. What I will say is this: the companies in this sector are not creating conflict. Governments create conflict. These companies exist to supply national defense, which every sovereign nation on Earth has engaged in since the dawn of civilization. The question of whether a particular war is just or unjust is above the pay grade of a stock analysis. What we are analyzing is, given that governments are going to spend this money regardless, is this a business with durable competitive advantages? And the answer, structurally, is yes. Let's get to the third pick, and this one might surprise you. It's not a missile company, it's not a jet fighter company, it's a company called Palantir Technologies, and if you haven't been following them closely, you should be. Palantir is a data analytics and artificial intelligence company with deep, deep roots in the defense and intelligence community. They were founded in 2003, partially funded by the CIA's venture arm InQtel, and their original mandate was to help the U.S. government make sense of massive, complex data environments. Think counterterrorism intelligence, battlefield logistics, predictive threat analysis, stuff that sounds like a movie but is very much real. Now here's where it gets really interesting. Over the past few years, Palantir has aggressively moved into commercial enterprise AI, and that expansion is real and growing. But their government business is what makes them a unique defense play. They're not selling bullets, they're selling the intelligence infrastructure that determines where the bullets go. In an era of modern warfare that is increasingly defined by information advantage, drone swarms, cyber operations, real-time battlefield AI, Palantir's product isn't a nice-to-have, it's the operating system of modern military decision-making. In 2023, Palantir's U.S. government revenue was $907 million. Their U.S. commercial revenue was growing fast, but the government side has something special: stickiness. Once a military branch or intelligence agency builds its entire operational workflow on top of Palantir's platform, switching costs are essentially infinite. You don't rip out the software that your special operations forces rely on in the field and replace it with something else. It's not like switching your phone from iPhone to Android. The integration is too deep, the training is too extensive, and frankly, the lives at stake factor makes the idea of a procurement switch almost politically impossible. The psychological insight I want to give you here is about category creation. The biggest returns in investing don't come from buying a better version of something that already exists. They come from buying into a new category before the market fully understands what it is. Palantir is not a defense company in the traditional sense. It's not an AI company in the Silicon Valley sense. It's something genuinely new. A national security AI infrastructure company, and the market has been struggling to price that correctly for years. That uncertainty is your opportunity. Now, I have to be honest with you about the valuation. Palantir trades at a premium. It's not cheap by traditional metrics. The price-to-earnings ratio has been eye-watering at times. But here's what most people don't realize about high multiple growth stocks in defensible categories. The multiple compresses as revenue scales. If Palantir continues to compound its revenue at 20 to 25% annually and the government contracts keep expanding, the stock that looks expensive today on a trailing basis can look very reasonable on a forward basis in 3 to 5 years. This is the same mental trap that caused people to sell Amazon at 50 times earnings in 2012, not realizing the earnings were about to grow 30-fold. Let me put some math around this whole portfolio idea for you. Let's say you took $15,000, which, yes, I know is not small money, but stay with me, and split it equally, $5,000 each, across Lockheed, RTX, and Palantir. You're getting aerospace and missile dominance with Lockheed, diversified air defense and services with RTX, and cutting-edge AI military intelligence with Palantir. What you've built is not a bet on any single conflict or any single contract. You've built a portfolio that benefits from 3 different layers of the same megatrend: the world rearming, the world modernizing its defense, and the world digitizing its security infrastructure. Now, here's the sobering, uncomfortable truth that I want to leave you with. The reason these stocks exist, the reason this sector is booming, is because the world is not getting safer. The post-Cold War peace dividend that shaped the 1990s and 2000s is over. We are living in a multipolar world with rising great power competition, regional conflicts that keep escalating, and a cyber threat landscape that gets more dangerous every single year. Nobody wanted this world, but here it is. And there are 2 ways to respond to that reality. You can feel anxious about it, close the news app and hope your S&P 500 index fund carries you through, Or you can understand the financial mechanics of how this moment works, who profits, how they profit, why it persists, and make an informed decision about whether to participate. Here's the thing, being informed is not the same as being callous. You can care deeply about peace and still understand that defense companies are publicly traded businesses that follow economic laws. The most ethical thing you can do as an investor is make clear-eyed decisions based on reality rather than the world you wish existed. The defense portfolio isn't about rooting for conflict. It's about recognizing that in the world that actually exists, capital flows toward national security the same way it flows toward energy, healthcare, and food. These are the non-negotiables, and companies that serve non-negotiables, especially with government contracts, monopolistic competitive positions, and 30-year program life cycles, tend to be exactly the kind of businesses that build serious, long-term wealth. Lockheed Martin for the long-duration platform dominance, RTX for the air defense and services recurring revenue model, Palantir for the AI infrastructure that every modern military is going to need. 3 different entry points into the same structural reality. Do your own research, set your own allocation, and think about where this fits in the broader context of your portfolio. But don't ignore it because it makes you uncomfortable. Ignoring reality has never made anyone wealthier. Understanding it has. If this video gave you something to think about, give it a thumbs up. It genuinely helps more people find this content. Drop a comment below and tell me, do you currently have any defense exposure in your portfolio? I read every comment. I'll see you in the next one.